Good morning, good afternoon, everyone. Thank you very much for coming out in this really horrible weather for June 13th. We appreciate your attendance, and I will tell you that my goal is to make sure that by the time you leave this room, you have information you did not have when you came in that will add value to your business, your client's business, and what you do in your everyday world. So for those of you that don't know me, my name is Pamela Michaels, and I am a senior vice president with a company by the name of Asset Preservation. Asset Preservation is a nationwide qualified intermediary. So if you don't know what a qualified intermediary is right now, QI, I promise you will know what they are and what they do by the time you leave. Before I get into the nuts and bolts of our seminar, I would like to give a big thank you to our sponsors. Our first sponsor is Nationwide Planning, and the principal is Eric Bickniece, and he has been here greeting you, and he will talk to you during our portion of our presentation about replacement property options in a 1031 exchange. Let me just say that replacement property options are the most critical part of every 1031. I'm going to go over the details of how you perform a 1031 properly to withstand audit. But you can follow all of those requirements, and if you don't have your replacement property lined up in time, your exchange will fail, and it's all for naught, and all the work we did was for naught. So Eric is such a critical part of the exchange. I can't emphasize that enough. Replacement property is critical to completing your 1031. I would also like to extend a big thanks, and Ron is not here yet. By the way, everyone, turn around. There's Eric Bickniece. Wave. There's your man. Ron Fuchs is not here, and I will tell you that he will be here shortly, and I will introduce him at that time. He probably got caught up in the rain. Ron is with Cantor Fitzgerald, and this is their fabulous space. So I'm here presenting, but Eric and Ron handled all the financial arrangements, so we owe them a big thank you. And if you have the opportunity to do business with them, that would certainly be wonderful. I can tell you Cantor is in the DST business, which is what Eric's going to talk to you about, and also Cantor is involved in an opportunity zone. So they've got all kinds of good products on the market today. All right, so let's get started. This is a fast-paced event. We have a lot of information. Now that said, I will say to you that I'm going to open up for questions at intervals. I will take a certain amount and then I have to move on so that I cover my material. At the end of the seminar, Eric and I will be here for questions, and it's also very important that if you did not already, you pick up our business cards, because you are free to email Eric or I, call us anytime you have a question about any of our services, and we're more than happy to help you. Okay, now I need to talk to you a little bit more about asset preservation. I mentioned they're a qualified intermediary. Qualified intermediaries are a creature of the tax code. Anyone desiring to perform a 1031 exchange must engage a QI, qualified intermediary, to facilitate the exchange. So that is our entire business. Now we happen to be wholly owned, by a 125-year-old publicly traded company, Stewart Title. And this fact is extremely important because when we are chosen as the qualified intermediary, by law, the QI is required to hold the net equity from the sale, which means at any one time, we're holding millions or billions of dollars. So if you are selecting your qualified intermediary, you're going to want to make sure they have expertise, experience, and financial backing. And that's where our 125-year-old publicly traded company comes in. Okay? So that's the importance of that relationship in the 1031 world. As I said, we have a lot to cover. I'm not going to go over the outline. I'm going to jump right into the materials. And the first topic for discussion is what code provisions provide opportunities for individuals or companies to defer or exempt their capital gain taxes from, from being taxed. The first one's 1031, and we're going to talk about that for the rest of the 2 hours. So I'm just going to mention that when you are selling real property that you've held for use in a trade or business or for investment, 1031 gives you the opportunity to defer your capital gain taxes. So what we're talking about here is capital gain taxes, and you can defer it forever if you keep continuing to do exchanges and do not liquidate. And we're going to talk more about how long that can go on and other benefits during our presentation. 1033 is involuntary conversion. So if your property is condemned by a local authority, they need to use your property for roads. Or if you have a property that burns and you get insurance proceeds, those proceeds from condemnation or insurance are covered under 1033. You do not need a QI, qualified intermediary. You have the opportunity to reinvest those monies within a certain amount of time and not pay your capital gain taxes. So that's 1033. Section 121, most people are familiar with. Section 121 is the provision that allows anyone that has owned and lived in their primary residence 2 of the last 5 years to defer their capital gain taxes, up to $500,000 if they're married, filing jointly, and $250,000 if you're single. We're going to see at the end of the seminar, hopefully I will have time, that there are times when you can actually use 1031 and 121 together, and you can get the best of both worlds. So I'm going to give you some examples about how and when that can be used. The old version of Section 121, if there are those of you in the audience that are my age or older, you might remember, but you had to buy another primary residence to get the exemption. No more. You pocket that $500, go to Tahiti, do whatever you want to do. It's a very liberal law now. The only problem with 121 is it certainly has not kept up with inflation in New York. And people that have owned a primary residence here for 10 years have a lot more than $500,000 of gain. So that's when we need to get very clever and figure out how do we also get the benefit of a 1031 so that we don't have to pay a huge amount of tax on the sale. Section 453, that's simply the situation where we sell a property, let's say our sale is for $5 million, and we get $2 million up front from the buyer, and we take a note back for $3 million. And the note is paid over 10 years. So the tax treatment of that note is covered under Section 453 of the Code. And it's called an installment sale. And when you receive financing for the sale of your property, the result is that you'll pay your tax on the $2 million that you receive up front, and then as and when you get the payments under the note for the $3 million, you'll owe the tax on that amount when you receive it. So you owe tax later. Now, let me point out to you that 453 and 1031 are not easy to use together, and I will try to have time to address how they can be used together. But if you are signing a contract for sale and want to 1031, please make sure that you speak to me before putting a seller financing provision in, because it could, in certain instances, prevent you from doing a 1031 or limit your benefits from the 1031. So you're going to want to know those options before you've put the pen to paper. Finally, 721. Rarely used, but used when a REIT perhaps wants your property and you've got a prime property in New York City, they want to buy it, you don't want to sell it in a taxable event, so you contribute the property to the REIT, and in exchange you get operating partnership units. That is not taxable under Section 721 of the Code, and the result of that transaction is that generally a couple years down the road, those operating partnership units convert to shares of stock, and then you own shares of stock in the REIT. Now, you can't 1031 those shares, as you're going to learn shortly, but now you have shares that you can liquidate as and when you want. So that's attractive to some people, particularly where a REIT is looking at their property. Okay, so that is the coverage in the code today of opportunities to defer or exempt your capital gain taxes. And there's one last section. Who knows what it is? It's the talk of 2019. Opportunity zones. Okay, but we're going to have a slide where we talk about compare and contrast opportunity zones, and we're going to get to that shortly. Okay, what capital gain taxes are we deferring today? Our federal, state, and local. And our capital gain taxes today remain at an all-time high. And they have been this way since January 2013. I thought we might get a break with the Tax Cut and Jobs Act. We did not. They did not lower capital gain rates. So let's have a summary of what they are today for most investors selling. On the federal level, most investors are going to pay 23.8%, which is a combination of 20% on the basic capital gain and the net investment income tax of 3.8%. Those taxes are assessed if your adjusted gross incomes, the 20% level, comes into play with adjusted gross incomes for single filers of 434 or more and married filing and jointly of 488. Now, prior to the Tax Cut and Jobs Act, those numbers were slightly lower. They increased about $25,000 each, so they didn't give us much of a break. So anybody with AGI over those amounts is going to be pushed into the 20% tax bracket, and pretty much that's all of my clients. The 3.8% tax rate applies at an even lower level, at the level of $250,000 and $200,000. So if you're in the 20%, you automatically have you automatically have 3.8% additional tax due. So let's go back again and look at the overall. So 23.8% is the federal rate, except if you depreciated your property, all of the depreciation on the sale is taxed at 25% on the federal level. So let's say you're selling it for $5 million. Let's say you bought it for $1 million, you have $4 million of gain. Let's say you depreciated $3 million. $3 million of the $4 million is going to be taxed at 25% on the federal level. The balance of $1 million will be taxed at 23.8%. And then we have what? New York State taxes of 6 to 8%. And if we're lucky enough to live in the lovely city or one of the boroughs of New York City, or our property is here, there's a local tax as well of almost 4%. Before you know it, the average individual is paying 35% of tax on their capital gain. That's a lot. So if you sell a property and have $3 million of gain, you're going to be paying over $1 million of tax if you do not perform a 1031 exchange. That's why this room is so crowded. That is why my phone is so busy. And thankfully, we have 1031 to help us through that terrible tax situation and invest that property in more real property. This is a pretty interesting slide, and I'm sorry, I'm not allowed to move from the microphone. Let's compare and contrast 1031 and Opportunity Zone. So first of all, 1031, you have to be buying and selling real property. Before the Tax Cut and Jobs Act, we actually had 1031s as well with personal property. It wasn't a significant part of anyone's business, but we did corporate jets, precious works of art, things like that. Now, real property to real property. Opportunity Zone, you can have a gain from the sale of a business, from sale of personal property, from the sale of stocks, and that gain can be invested in a fund. You cannot use a fund as replacement property in a 1031. Why? The fund might own real estate, but you're an investor in the fund, like a mutual fund. You are buying a personal property interest. And you'll see that that's important as we go through a couple more slides. So owning real property. There are no, I'm going to take questions at intervals if it's okay, hon, just to make sure we get through our information. Okay, so time restrictions. With an Opportunity Zone, you invest for 5, 7, or 10 years to get benefits of deferral or tax exemption. There is a very significant misunderstanding that with an Opportunity Zone, your capital gain becomes tax-free. That's incorrect. Let's discuss what's tax-free. So let's say you sell a company and you have 10 million of capital gain. You sell the company for 20. You put 10 million of gain into the zone. You don't have to invest the whole 20. The gain gets invested. Your basis in that 10 million on the day you invest it is 0. Okay? Now, 5 years down the road, if you leave your money in the investment, you get a step up in basis of 10%. And 7 years, you get an additional bump of 5. So at the end of the 7 years, you have a basis that's got a step up of 15%. But the law requires the gain that's remaining, that 85% of your gain, has got to be paid in December of 2026, regardless of whether you take your money out of the fund or not. So the gain that you go into the deal with is not tax-free. It's deferred till the end of 2026, which means you're going to pay it in April of the next year. You don't have a choice in that respect. What is tax-free is if you leave your $10 million in that fund for 10 years, any profit made on the $10 million. So let's say at the end of 10 years, you get you get 11 million back. You made $1 million. That $1 million is tax-free, which is, there's no small, that's a wonderful thing. But it's very critical that people that are investing in these funds understand that they're not getting tax deferral forevermore on their original gain that goes into the investment. They're going to owe it in 2026. 1031 endlessly deferral. You can swap till you drop, okay? And on the date of death, your heirs get a stepped up basis in the property and the capital gain disappears. It doesn't mean you don't have to pay estate tax. That you need somebody with a different hat to explain. But you don't have any capital gain taxes. So at 1031, anywhere in the U.S., U.S. to U.S. is like kind. Foreign property, we do exchanges, but there's not a safe harbor for it. There's authority that indicates foreign to foreign qualifies. But we absolutely know foreign to U.S. and U.S. to foreign is not like kind. You cannot do those type of exchanges. In both 1031 and the Opportunity Zone, you must invest your proceeds or gain, depending on which provision you're working with, within 180 calendar days of the sale. There, in the Opportunity Zone area, there are some exceptions to that. It might be within 180 days of the end of the tax year in which the taxable event occurred. So for Opportunity Zone people, you need to talk to your CPA about when that deadline occurs. For 1031, trust me, it's 180 calendar days from the sale of the relinquished property. Time period is written in stone. Okay? Real property only in a 1031. So remember that as we go through this. Now, why is 1031 still the best choice for real estate investors? Control, complete control over your investment. In a fund, somebody else is managing it. Whether you make money or lose money is up to the fund. Second, tax deferral, as I mentioned, can go on forever and ever. In an Opportunity Zone, not the case. Flexibility and timing. You can choose when and how you pay your taxes in a 1031. You don't have that choice in an Opportunity Zone. You get a stepped up basis on the date of death with 1031s. You don't have that option or benefit in an Opportunity Zone. And with 1031, you get all real estate related tax deductions because you're invested in real estate. Even if the fund owns real estate, which in most cases it does, you're not going to get those benefits because you're not a real estate investor when you own part of a fund. Okay, so those are some of the high-level distinctions. A couple of more. So with a 1031, you're going to hear me beat into your brain how much you have to spend in replacement property to 100% defer. But once we've got that concept down, and once the exchange is over, you can refi the property, pull the money out, and do whatever you want with it. And it will not violate the 1031 rules. And and I mentioned this already, with an Opportunity Zone, you're going to have the cash to pay your tax at the end of 2026. You may need to pull the funds out to have that, or you may have to reach into another pocket. But a 1031 investor doesn't have to pay taxes any particular time. You can decide in a 1031 when you're going to have and incur a tax consequence. So those are the main distinctions. Let me switch back to just speaking about 1031 exchanges. And in 2017, when the Tax Cut and Jobs Act was getting enacted, and we were hearing about what might come through, what might be passed, 1031 was at risk. We fortunately survived and only had one change, and that is, as I mentioned earlier, you have to be buying and selling real property. It cannot be personal property. Remember this concept when I get into the discussion about partnership and LLC interests. All right, as I've mentioned, for 1031 purposes, you have to be selling and buying investment or property you've held for use in a trade or business. Both the relinquished and the replacement have to meet these requirements. But what does that mean? Well, held for use in a trade or business is fairly easy to understand because, let's give some examples. It's the gas station owner that owns the dirt, the land on which the gas station sits. That's his trade or business. Automobile dealership owns the dealerships and the property underneath. Trade or business property. But held for investment has a trickier definition in the IRS's mind and in the Internal Revenue Code than it has to us in our everyday use. Pretty much any time we buy something and plan to make money, we think it's investment property. That's not enough for 1031 purposes. The IRS will look at about 8 or 9 different factors to determine if you held property for investment purposes. And those factors are set forth on the screen. They want to know why you bought it, what you did with it, how the extent of any improvements, how many 1031s have you done in the last year, what's the size of those transactions. And there's one very important factor I didn't put on here, and it's on the next couple slides, how long you've owned the property. That last factor, many people think, is the only factor. And people also think as long as you've owned it a year or more, you're safe. Well, there is no holding period that will specifically ensure or that's provided for in the code that will give you absolute certainty that you've held for investment. It's a facts and circumstances test. So you have to establish, regardless of how long you've owned the property, that you have held it for investment and not primarily for resale. So people that flip properties don't qualify. They bought them, fix them up, put them back on the market. Flippers don't qualify. The holding period, there are 2 viewpoints, and that's what they are. The liberal view is a year or more, and the conservative view is 2 years or more. And the reason 2 years or more is a conservative view is because many years ago, there was a private letter ruling issued that applies to one particular taxpayer, where that taxpayer had written in and asked the IRS, do I qualify? And under his facts and circumstances, they said, yes, we think 2 years is sufficient. But I'm going to want a 2 years that's clean. I don't want resale activity. I don't want offering the property for sale, listing it for sale, negotiating contracts. So if you're using the 2 years, try to make it a clean 2 years. And if you're using 1 year, make it a clean 1 year. Are you absolutely disqualified if you sell a property after owning it for 15 months and you were negotiating contracts in the first year? No, it's a facts and circumstances test. And there can be a situation where you buy property and the next day Amazon announces it's coming to the area and the property you bought just triples in price and you get unsolicited offers. Even though you had plans to redevelop in that property into a multifamily building and you had pro formas and architects working on the project and so forth. Now, is that a situation where you might withstand audit even if you sold it very short term? Possibly. But this is where I refer you to your CPA and attorney and tax attorney if needed. Because even though I'm a lawyer, I cannot give legal or tax advice in my role as a qualified intermediary. So I can give you guidelines, I can tell you what other people have done under similar circumstances, and I can provide you with regulations and case law on similar facts. But that's that's where the line I go up to, and after that, where we're applying the law to your facts and circumstances, that's where your CPA and attorney will get involved. And I should also tell you that I work as a team with the listing broker many times, with the financial advisor such as Eric, with the lawyer, with the CPA. We work as a team on the sale of the relinquished property. Every one of us is critical to the 1031. A couple situations, and I'll mention them in Goolsby and Reasoning. They were both properties acquired, residential properties acquired, and shy of a year, in both cases, they were converted to a primary residence. That's a no-no, okay? Primary residence is not held for investment. Property used exclusively for personal enjoyment is not held for investment. So that was a no-no. But it's very interesting that in Goolsby they were struck down, and in Reasoning the transaction was upheld. So what were the differences? Facts. The facts were very different. Goolsby, the home they bought it, the HOA prohibited rental. They never tried to rent it, they just moved in. So there were no good facts showing intent to hold for investment. In Reasoning, they tried to rent it. They had showings of the property. And after not being able to for some time, they got into economic distress. They couldn't maintain and afford their primary and this investment property. They were able to sell their primary, so they moved in. So they had very good facts and withstood audit. I don't recommend moving in shy of a year or even shy of 2 years, but in egregious situations, you can still withstand audit. Okay, here's one more case where Mr. Allen bought some vacant land and tried for almost 10 years to subdivide it. Actually, it was probably the first 5 or 6 years that he tried to subdivide the property. He was unsuccessful because he couldn't raise enough capital, and he gave up. And 4 or 5 years later, he sold it, did a 1031. Tax court says, we do not see that you changed your intent from primarily for resale to hold for investment. You were always trying to redevelop this property, subdivide it to sell lots or build homes and sell lots. And that's what we see in your actions and in the writings. And even though it took you several more years to sell it, we are striking down your transaction. A good or bad case, I don't know. I always talk about this case because it shows how even long-term ownership with bad facts can result in disqualification if you're audited. All right, partnership and LLCs. Pretty much anyone that is selling property today, or buying property for that matter, where there are multiple investors, own the investment in a multi-member LLC taxed as a partnership. Partnership and membership interests, I'm going to use the terms interchangeably, are personal property. The LLC that's on the deed and filing the tax returns owns real property, unless it's a single member disregarded entity, single member disregarded LLC, which was not my example. I said multiple investors. But where we have a single member disregarded LLC, disregarded means the LLC does not file tax returns, and the tax returns are filed by the sole member. In that case, the sole member owns real property. But where we have a multi-member LLC or partnership, the only party in that transaction, in that structure that owns real estate is the LLC, which means only the LLC is qualified to do the 1031. But in our world, what happens? Let's say we have 3 brothers. When they were in their 20s, they invested in a piece of property for $3 million. It's many years later. Now it's worth $9 million. And not only are the brothers no longer so young, but now they have families. So they're about to sell this piece of real estate. They all want a 1031, but they all want to go their own way. They want to do independent 1031s. And my answer when they say that to me is, as you are currently structured, as your ownership is currently, as it currently exists, you cannot do that, because partnership or membership interests cannot be sold as relinquished property in a 1031. So there are 2 options. The first option is known as a drop and swap, and the second option is known as a swap and drop. Has anyone heard of these terms? Okay, few of you. Drop and swap refers to having the partnership deed 1/3 of the property to each brother, because each is a 1/3 owner. So the partnership would prepare a deed giving each brother a 1/3 ownership interest in the $9 million property. And for safety concerns and to ensure that they're not subject to personal liability, they would probably each form one single member disregarded LLC. So there'd be one deed, and after the deed, we have 3 brothers on title, or 3 LLCs on title. And now, we want them to be converted from partners to tenants in common. That's a legal term, tenants in common. And there are certain benefits and burdens that must exist to be tenants in common. Most significant is you must have a pro rata share of the profits and losses, voting rights pro rata, everything pro rata, no preferred rights. So if you've got a lawyer that's on the ball, you'll be preparing and signing a tenant in common agreement. You'll be changing your actions from operating as an LLC to operating as tenants in common, bank accounts, legal documents, everything, insurance policies. And then you do what? You season your tenant in common interest, which means you work to ensure that you are able to establish that you held the interest for investment. So how long do you think that means that the tenants in common need to own the property?
1 year.
1 year. Now we can sell it and feel fairly comfortable we're audit proof. How many of my clients do you think come to me in that situation? Very few. The ones that have heard me lecture for years maybe got their act together and converted their LLC a long time ago, but in most cases there's a lender and the lender won't allow the conversion. So in most cases the situation is that they're waiting to drop down the property until the contract is already signed and they're pretty much at the closing table because they can't disturb the loan. And in that case, all I can tell them is speak to your CPA and your attorneys. You have a risk. You have a risk that you could get audited and disqualified as not holding for investment your tenant in common interest. Their best position under our case law, which there is case law upholding but not in our jurisdiction, is that the same exact people have had the same exact rights and benefits all along, and we therefore should be able to tack on the long-term holding period of our interests as partners or members to the short-term tenant in common to establish long-term investment intent. That's the position. Now, no guarantees. We do an awful lot of drop downs between contract and closing. It's not the best situation, but with the proper legal and tax advice, the clients get comfortable with the position. The worst case scenario, however, is you get audited, and you get audited down the road after your $9 million, each brother's reinvested $3 million in different properties. Now they want their capital gain because you lost the audit, and the money's in property. So that's why it does involve some risk, and that is why swap and drop, the second option, is used by my clients that are very conservative. So let's talk about what that means. So the swap and drop, you keep the partnership of the LLC intact. You do your exchange. That's your swap. The partnership buys multiple properties. In my example, where I have 3 brothers, we might buy 3 properties. In the partnership name, how long do you think that the partnership retains ownership of those properties? 1 or preferably 2 years. Then what do you think happens? They distribute one property to each brother because with partnerships and LLCs, pro rata distribution of partnership assets are not taxable. This is a wonderful tool. So when I give each brother one property, as long as it's still pro rata, it's not going to be a taxable event. Now we have a problem where one property went to 10 million and one property went to 1 million and one stayed at 5. Now we're distributing properties and it's not pro rata. So the way that that's handled is either they buy assets that they believe will relatively stay the same, or they buy into one building together, so the building is going to go up or down and it's the same to all of them, or they buy a DST, Delaware Statutory Trust, and Eric will talk to you about that. DSTs are ideal when you want to do a future drop down. Okay, but that makes it safe because the partnership, our tax owner, stayed intact. We cannot have changes of our tax owner soon before or soon after an exchange, it will disqualify the exchange. So if if you own property you've held for investment and you've been renting it out, now you want to give it to your daughter. Don't give it to your daughter, because your daughter the next day is not going to qualify as held for investment. You're the one that had held for investment. You had qualified it because you'd owned the investment so long. So you have to be careful with any changes of title when you're contemplating a 1031. So those are two options, and I have to tell you that partnership and LLC matters are so complex you cannot apply one answer to all facts. Every deal needs to be analyzed based on its own facts and circumstances, and it's very critical. The earlier you get the advice and get in front of a QI or a tax attorney, the better. And I want to make one more point, because people walk away confused. S corporations, C corporations where you're a shareholder cannot drop down. There's no exemption for that drop down. So if you have an S corporation and 5 family members are owners, you are not getting out of that in your 1031. That S corp has to buy and sell. And what I recommend to those investors is that I connect you with a very strong tax attorney, because after your exchange is completed, you may be able, over a many-year period, to restructure that asset and the ownership in such a way that the tax liability is mitigated. But C and S corps don't have the same benefits as partnerships or LLCs. Okay, now one more topic about our partnership before I move on. This is very complex. So if I lose you, don't worry. You can call me if you have a situation. I'm going to give you an example of a partnership selling for $10 million with 10 investors, equal investors. 2 investors don't want to participate in the 1031. They want to liquidate. They want their $2 million. The partnership doesn't have it somewhere else to use $2 million that's sitting in their bank account to redeem their interests. They can only use it from their 1031 funds. So if the partnership sells for $10 million and takes $2 million of the proceeds and buys out liquidating partners and continues the exchange with $8 million, that's a partial exchange, and there'll be $2 million of taxable boot, and that boot is taxable to the partnership and each partner pro rata, not just to the liquidating partners. Now, people always say, can't we just have a partnership agreement or some kind of agreement that they're going to have the responsibility? What if they don't pay? And then back to all partners being equally liable. That is not what that partnership wants, ever. In those cases where the core is staying together and we need some money and it needs to come from proceeds to liquidate, we use what's called a partnership installment note. Okay, bear with me. $10 million would be paid in by the buyer at closing. $8 million would go into the client's 1031 account. $2 million would go into a commercial bank account owned by API. It's not a 1031 account. Simultaneously, we issue a note to the partnership for $2 million because we're holding your money. That 1031 account with $8 million is yours, but the $2 million account is ours. So we have to issue an IOU. The note by its terms must stand up to the test of an installment note, which means some portion of the note that bears economic substance must be due and payable in the next tax year. Why? Because with an installment note, as I told you in the very beginning when I was covering Section 453, you're not taxed on it when you get the note. You're taxed on it when you get the payments. We don't want the partnership to bear the tax on the $2 million. So we make it an installment note, and the partnership immediately turns around and assigns the note to the exiting partners. So when the first payment is made, which is generally 2 weeks after closing, and it's usually 85 to 95% of the note, the liquidating partners receive the payment. So even though the $2 million is boot to the partnership, they don't owe the tax on it. It's redirected that tax liability to the parties that are getting the money, which is exactly what the partnership wants. Okay, that's partnership installment note. Now the partnership continues and does an exchange for $8 million. We require a tax attorney to be involved when we do a PIN structure because it's not covered by a safe harbor of the code. And also the tax attorney has to tell us what portion of the note has to be due and payable in the next tax year so that it will qualify as an installment note. It will stand up to the test of the IRS. So it's a very useful tool. There's a lot of other parts of a PIN I could talk about, but time does not allot. I just want you to have the concept in your mind because this comes up an enormous amount of time with investors coming and going, and the partnership's not able to raise the funds elsewhere, and they do want to let these people go, but they don't want to have tax liability for allowing them to exit the partnership. Like-kind property. You can go from commercial to residential, income producing to vacant, anywhere in the U.S., any type of property as long as what? Held for use in a trade or business or held for investment, right? Okay. Anything qualifies. Some creative types of 1031 property, air rights. You get your neighbor is going to build a building, they want your air rights. They pay you $10 million. Your air rights have no basis. That whole $10 million is gain. Perfect for a 1031. Vacation homes. I mentioned earlier, property that you use exclusively for personal enjoyment does not qualify. How can you convert a vacation home into 1031 property? The 2 years prior to sale, you have to limit your personal enjoyment to the greater of 10% of the time rented or 14 days, whichever is greater, in both of the 2 years preceding sale, and you have to rent it at least 14 days a year. So if something in the Hamptons has always been, your family goes out there every summer, and sometimes you go out in the winter, but you've never rented it. Be careful, don't go to contract, convert your use, rent it as much as possible, and make sure to limit your personal enjoyment to that 14 days or 10% of the time rented for those 2 years. Make sure to tell your CPA, and now you fit within the safe harbor that was enacted in 2008. Likewise, you're buying something that down the road, and down the road is critical, you're going to use for personal enjoyment or for your primary. For the first 2 years, make sure you fit in the revenue procedure, and then you're safe. Okay, so it's nice to have certainty. The problem is, what if we don't fit within this revenue procedure? Are we disqualified? We're already under contract, and we rented it some, but we used it some, and we don't fit within this limitation. Now what? I would talk to your CPA, because if you don't fit within the safe harbor, you could easily get disqualified. Okay, co-ops qualify. Why do you think co-ops qualify? Didn't I say you could only do this with real property? And what do you get with a co-op? Oops, did I go too fast? Shares, and what else?
Lease.
Aha, long-term proprietary lease. And guess what? Long-term leases are like kind to real estate as long as the term is 30 years or more, including unexercised options. So for many reasons, some of the statutes you see on the screen, co-ops are considered real property, and we can use them in a 1031 exchange. But the catch is, you better be able to rent them. Because if you can't rent them, then what? You can't use it for yourself. If you use it for yourself, it's personal enjoyment property and it doesn't qualify. So you have to be a little careful with co-ops. We talked about shares in a REIT not qualifying. They're personal property. Clients call me, and when they tell me I want to go into the replacement property that shares in a REIT, what are they asking me? What are they telling me? They're talking about a Delaware statutory trust. Eric's going to talk to you about DSTs for about 20 minutes. He's going to give you all the details, and you will see how they walk and talk a lot like an interest in a REIT. But they're not. DSTs are covered by a safe harbor in the code, so you have absolute certainty when you invest in a DST that they will qualify for 1031 purposes. Okay. Now let's revert back to our discussion about the exchange equation, which is the second basic requirement of every 1031 exchange. The trade up or even in value means you're looking at how much you sold for. In my example, we're selling for $5 million. Our debt was $2.5 million. Our exchange expenses are $300,000. And so therefore our net equity is 2.2. So when you call me, I'm going to ask you a lot of questions. I'm going to say, how long have you owned the property? What is it? Where is it? How do you hold the title? If you tell me an LLC, then I'm going to ask you who files the tax returns, because I want to make sure I know who the tax owner is. I'm going to ask you the amount of mortgage debt. All of these questions, I'm making sure I qualify the deal. I don't see any red flags. If I see red flags, I'm going to let you know and send you back to your CPA. And I'm trying to figure out what numbers you need to match to meet your exchange equation. So in this example, I know you need to buy property worth 4.7 or more. And I know that up to 2.2 million, that up to 2.5 million can be mortgage debt if I don't go over 4.7. If I trade up, any trade up above 4.7 can be mortgage debt. But if I trade exactly into 4.7, I can't have any more than 2.5 million of mortgage debt on the property because I won't have enough to get my 2.2 of equity in the deal. And both need to be in place. So in this example, we traded up, and therefore we have no mortgage boot and we have no cash boot. Okay, next slide. And a perfect exchange. All right? Now, the next slide, we traded down. The minute you're telling me you're going from 5 to 3 on the phone, I'm going to say you're going to buy additional replacement property? No. Then you're going to have $2 million of boot less your exchange expenses, $1 million of 7. And that's exactly what happened here. Trading down is not the end of the world. It's a partial exchange. You still may get some benefit. But when you're doing a partial exchange, I need to send you back to your CPA. Why? Because unless you end up buying property that has a value greater than the adjusted basis in what you sold, you won't get any benefit from the 1031. And offline, I will walk through that and some calculations so you understand why. You get deferral to the extent you spend more than your adjusted basis. So if my adjusted basis in this property was $3 million and I spent, what did I spend? $3 million. I'm getting no benefit because I paid $2 million in taxes before, without the exchange and with the exchange. If my basis was $2 million and I spend $3, I'm going to defer tax on $1 million. So I get some benefit. So anytime we have a partial exchange, we have to do an analysis before the client starts the process and sells and pays us our fee to determine if the client is going to get any benefit. Because if the client's determined to trade down and they're not going to get a benefit, then don't do a 1031. But partial exchanges are done, and they're done commonly. It's not unusual, but we just have to go through a little more analysis. Okay, so what are these that $300,000 on both slides? What are those fees that I can pay from my proceeds without tax liability? They are transfer taxes, recording fees, legal fees, our fees, QI fees, and title insurance fees on the purchase and broker's commissions. Okay, that's what that $300,000 amounted to. Any other fees that we pay out of that sale price is going to create boot, B-O-O-T. Prorations and adjustments you can deduct from the proceeds, but if they net out in favor of the buyer, so you having to pay some of that, it's going to end up resulting in boot to the client. Now, generally that might not matter because real estate taxes are deductible, so that their taxable boot, it's a wash. But there are other types of transactional costs that create boot that are not deductible. Let's think about it. Let's say we're selling a large multifamily building, $30 million, and we're holding $3 million of security deposits. In a regular real estate deal, we would simply credit the purchase price, $30 million less $3 million of security deposits, and $27 million would come in by the buyer. You do that in a 1031, and that $3 million is taxable boot. Ouch. So, any kind of credits to the purchase price in the 1031 to avoid it being boot, the seller either needs to bring that amount to closing or POC, pay it outside of closing to the buyer to avoid having a credit against the purchase price of, in my example, $3 million, and that being boot. It's very hard for real estate lawyers to get their minds around this, that you cannot credit. If you were supposed to repair the roof and you fail to, and it's going to cost $1 million, and you credit the purchase price for that, that's $1 million of boot. Again, it needs to be POC'd, somehow, some other way paid. So anytime, if you're a real estate lawyer and you're doing the closing statement, you see credits to the purchase price, red flag, give us a call. Let's see how that's going to be treated. Let's see if that's acceptable to the buyer, to the seller. Buyer doesn't care. And then decide how to best structure the sale. Okay, all we've talked about so far is our forward exchange format. And after Eric speaks, I'm going to talk to you about more complex exchange formats, the parking arrangement type of exchanges. But what you see on the screen is a depiction of how it appears to perform a forward or delayed exchange. The qualified intermediary holds one thing, the money, not real estate. And what happens in a forward exchange is that the client will sell to the buyer, the funds come to the qualified intermediary, and then we hold those until you're ready for your purchase. Then we fund the purchase, and the deed goes directly from the seller to the client, the exchanger. The deeds do not come to and from the QI. This is your third basic requirement I'm about to address, and that is the timelines you have to complete your exchange. In a 1031 exchange, you have 45 calendar days to identify your replacement property, and that runs from closing. And you can't tell me I've already identified before you've closed on your sale, because identification is a formal process by which you are going to send us a document that you sign and complete listing any property you might want to buy as replacement property. And it has to be in our hands by midnight of the 45th day. These timelines are written in stone. You cannot violate them. Okay? Written in stone. So you have, after that 45 days runs, another 135 calendar days for a total of 180 to close on all replacement property you want to buy. After the 45 days, you cannot change your list. So it's critical that you provide backups on your list, or you could easily be at day 60 and all the properties you listed were sold to third parties, or you don't want them, and now you're going to end up paying your tax. And that was not the goal. The best strategy, if you can, is to, well, obviously, maybe not so obvious. So the best strategy is actually to close on all your replacement property in the 45 days, and you're done. No risk. How easy is that? Very easy if you go to Eric and you purchase DSTs. Eric's calling me for your money to buy the replacement before I've got it from your sale in most instances. The DSTs are such an organized type of replacement property, and the process is so streamlined. Okay? But most people can't achieve that unless they're buying DSTs, and sometimes you're buying DSTs as a backup or to fill a gap. So maybe you're supposed to buy $5 million of property and you've got $4 million, you got another $1 million you're going to put into DSTs. You usually don't know how much you have left over until close to the 45 days, and then you fill in the blank with the DST interest. So 45 days to identify. It's also very wise, if you can't close in the 45 days, to at least be under contract to buy all your replacement property. Otherwise, whether you're ever going to get a contract is anybody's guess, and you could end up not having a proper exchange because you can't close in time. So those are the best strategies, and let me talk about one final point before Eric speaks to you about DSTs. These identification requirements are very specific. The first thing is, as I mentioned, you got to get it to us by midnight of the 45th day. The second requirement for the ID is that you must fit within one of the three rules you see on the screen. Not all of them, one of them. So the first one states that you can identify 1, 2, or 3 properties, and if you identify 1, 2, or 3 properties, you're in good standing. You will have properly satisfied the identification rules. But what if you want to buy more than 3 properties, or maybe you want to buy 3, but you want one backup for each of the 3? So maybe you want to list 6. Then anytime you are going to list more than 3 properties, you have to use the 200% rule. And the 200% rule basically states that you cannot list more than 3 properties as long as the aggregate fair market value of all the properties listed on the day you identify them does not exceed 2 times what you sold for. So if you're selling for $5 million and you list 6 properties, what's the total value those 6 can have? This is a test. You don't get your certificate without this. The 200% rule says if you list more than 3 properties, the aggregate fair market value of what's on the list cannot exceed 2 times what you sold for. You're selling for $5 million. $10 million, thank you. Okay, $10 million. If I list 3 properties in that same example, how much value can they have? as much as $1 billion, okay? You only need to start doing math when you're going over 3, okay? So the final rule I've never seen used in my 15 plus year career in 1031s, but I'll give you an example of how it might apply. If you fail the 3 property rule and you fail the 200% rule, so you listed $12 million of property and you listed 6 properties in my example, you fail both. If you ultimately end up buying 95% of the value of what you listed, which pretty much means you're going to buy it all, you will pass the identification requirements if you get audited. Never seen it used. Don't rely on that rule. Try to fit within the 3 property rule or the 200% rule. And the final note that I want to make on this issue, Eric, your time's here, is that what is one property is a critical decision. So I had a client say to me, Pamela, I have 3 adjacent lots that I'm looking to buy from one seller. Is that 1 property or 3? Questions. Are they vacant? Vacant. Probably 3. Is there 1 building sitting on all 3? Probably 1. So you really have to be careful. Whenever there's a question, err on the conservative side and list them as separate properties, and then use the 200% rule if you need to. Okay? So a lot of tricky parts about identification rules. It is extremely tricky if you need to identify a DST interest, because anytime you're not buying 100% of an asset, you must identify an undivided blank percent interest in the property. And DSTs are fractional ownership interests. The same rule applies if you were going to buy a property 50-50 with a buddy of yours. You're going to have to identify not 100 Broadway, you're going to identify an undivided 50% interest in 100 Broadway as tenant in common. When you identify DSTs, you identify the percentage, you identify the DST, and you list the properties owned by the DST, because a DST can own multiple properties.
Okay, so I have here a 90-minute presentation. Got 20 minutes to deliver it. So I'm going to give you the most pertinent information. We're going to go through the most important slides. Like Pamela, I am going to send out the presentation to everybody that's here, so you'll get the whole presentation. I also do other events that you'll have an opportunity, you'll get an invitation to, where it's more DST specific, and I do take the whole 90 minutes to talk about the DST. The idea today, though, is to give you enough information to decide if you do need to learn more about it, right? So there's a couple of things. It's a replacement property alternative. The investment is actually offered as a Reg D private placement. So there's a couple of disclaimers that I just have to go through. One is that we do not make a general solicitation when we're talking about Reg D private placements, right? So there'll be no particular offering spoke about at this presentation. The other thing that's important is that because they are private placements, you have to be an accredited investor to invest in a DST. So an accredited investor has a $1 million net worth outside of the personal residence. For an entity, it's $5 million in assets. $5 million in assets is not a $5 million net worth. If you got a $5 million building with a $2 million loan, that's a $3 million net worth, but it is a $5 million asset. So you're qualified. If all of the members or owners of the entity are individually accredited with the $1 million net worth, excluding their residence, then that entity is qualified. It's important because we don't want to head down that road discussing a potential investment and find out that some members of the entity aren't accredited and not valid for that investment, right? So, I have to kind of briskly go through the slides. If you have a question, raise your hand. If I could take a quick question, I will. You can catch me after the presentation and I can answer any questions at that time, but there are certain slides I just have to get to. So yes. Delaware Statutory Trust. So we'll refer to it as the DST, okay? So the risk, this is actually easier than the slide might indicate because the risk is the real estate risk, right? So the DST owns an investment real estate property. The risks that are inherent in that real estate investment, if it has debt on it, that's the risk. There are some other components of the DST, some rules that it has to comply with, and I will get into all of that. But for the most part, the real estate risk inherent in that real estate exists in the DST investment. If they can't pay the loan and the bank forecloses, the property fails. All right, so I'll give you a basic a summary of a DST. Today, we're in the offices of Newmark Knight. They're owned by Cantor Fitzgerald. Cantor Fitzgerald is an up-and-coming DST sponsor. We're very grateful for the use of the room. You'll see that the presentation that I'm using is with Inland Private Capital. They are sponsors, and they're offering these DST products. So a sponsor like Inland, Cantor Fitzgerald, they will either buy an investment property that would otherwise qualify for the 1031 exchange, or possibly do a joint venture with an operator that already owns the property. They'll put it into the Delaware Statutory Trust. They want to manage that asset. They manage the property. They'll set up the financing if there's going to be financing. And then they will issue the beneficial interests to individual investors. So you're buying a beneficial interest in the trust that owns the investment property. The IRS recognizes that beneficial interest as ownership of the real estate that the trust owns for the purposes of the 1031 exchange. So at that point, you're a beneficial owner. You assume your share on a percentage basis of the revenue that is generated. It's net to you after all of the expenses, usually about 5% cash on cash. Your share of the loan, it's non-recourse debt. I'll get into a little bit about the debt because there are some things I do want you to understand. So you get depreciation that passes through as well. So it really is a real estate investment, even though it is offered to you as a security, but in essence, you're just a fractional owner of that real estate that trust owns. So the history, Revenue Ruling 2004-86, that's where the IRS recognized this as ownership of the real estate for the purposes of the 1031 exchange. You can see here that Inland Private Capital had some input with that in working that out with the IRS so that they could understand that structure because it became very important post-financial crisis. I'm going to get into that. But the DST is the dominant co-ownership structure now. There'll be well more than $3 billion in equity invested in DSTs in 2019. So understanding the product, I gave you that, that basic overview. What you really need to know, it's a co-ownership structure. We said that, right? A DST, a trust can own one property. It can own a small portfolio of properties. But once that DST is set and buys those properties, that's it for that DST. It's not it doesn't turn over the properties like a real estate investment trust. When the sponsor sells those properties, that DST ceases to exist. It's important to know that it's a passive investment. You don't have control. Now, I will tell you this. I'm one of a few handful of advisors that have been recommending these co-ownership investment products since before the financial crisis. I'm doing this about 16 years now. Prior to that crisis, these products were offered as a tenant-in-common investment, all right? And there was just a colossal failure, the whole tenant-in-common industry. And a lot of it had to do with the fact that as tenant-in-common investors, you would have 35 investors, all strangers, on title with a voting right. And there was a time when many thought that was a good idea. Until the financial crisis happened, property values dropped. You need to do loan workouts, sell property, find new tenants. You need a unanimous decision from all of the tenant-in-common owners. And that became difficult. So what I'm going to say, the DST structure, the trustee, the sponsor is running the deal, okay? They're on the loan. Back with the TIC investors, everyone had to send me 2 years tax returns, get approval for the loan. Banks won't deal with that TIC structure anymore. It was just too much of a headache. But what I'm going to say is this. If you're going to invest in a co-ownership structure and you're going to be a passive investor, you don't want certain people to have a vote. You don't want that unsophisticated investor that doesn't understand the deal, doesn't understand the workout process, to have a vote. You want to work with a quality sponsor with an extensive track record, okay? And you want to let them run the deal, or you don't want to be in the deal, it's not for you. It's as simple as that. So I go through a process where my investors understand what they're getting involved in. And if you're willing to go along with the sponsor and their business plan and the projected holding period and the earnings are acceptable to you, this is something that can work for you. My clients, 100% of them are at a point in their life where they don't want to manage real estate anymore. That's the number one criteria. That's the big thing. Why do people invest in a DST? I don't want to manage real estate anymore. And it's a very easy thing to get into. So I've got to move, though. Any questions, raise your hand. The benefits, you can 1031 exchange in and out of it. Obviously, it's a passive investment. No loan guarantees from the investors. It's a non-recourse loan, all right? So only the sponsor is on the hook for the loan. You don't apply for the loan. You don't qualify for the loan. You're not on the hook. Let me just say one quick thing about the loan, though. Non-recourse, so you're not liable. Has anyone ever had a client in a deal with a non-recourse loan where there was a failure? What happens? No one's raising their hand. That's okay. That non-recourse loan comes back to you as income when it's forgiven. All right? Cancellation of the debt. You get a 1099. Now you got income. And oh, by the way, you still owe the IRS your capital gains on the deal, and maybe your equity was wiped out. So just don't let someone give you an idea that, oh, it's a non-recourse loan, don't worry about it, you have no liability. You got a lot of exposure there, okay? But it is nice to know that the loan is in place, and when you invest in the DST, you assume your pro rata share of that loan, and you could cover your 1031 exchange. So you have a debt obligation. Pamela, you got that far, right, with the presentation? So you cover the cash, you cover the debt. So you don't have to get your own loan. You come out of a deal, you paid off $1 million loan, you go in, you got $1 million cash, you go into a DST deal with a 50% LTV, your $1 million in cash buys you $2 million worth of that DST. You just got $1 million in debt, you covered for the 1031 exchange. It's a very easy way. Question?
What if you have a sale with no debt?
So there's a great question. So you got a sale, you have no debt, all right? There are DSTs that are all cash. And the number one thing that I need people to understand, when you go into a deal that has debt and you came out with no debt, so you did two things. You took on a little bit of risk that you didn't have before. Because right, bank adds risk, right? The only way you can lose your money, the bank takes the property if you don't pay your note, okay? But the other thing is you changed the profile of your exchange now, because that exchange, you came out all cash. You did not have to cover any debt, right? But you took out new debt. The DST, the sponsor is going to sell that property in 5 or 6 years. That's the historical holding period. That's the best thing I can tell you. How long am I going to be in the deal? Well, historically, and again, I deal with sponsors with extensive track records that have dozens and dozens of properties that have turned over. We say 5 or 6 years. The loans are typically 5 years interest only, 5 years amortization, right? You sell a property in the 5th or 6th year, you didn't pay off any of that debt. So you came out of an all-cash deal, you went into a deal that had some debt on it, and the property gets sold. Now you have debt you have to cover the next time around. So we make that very clear going in, right? Because people will say, oh, but I had an all-cash deal. You had an all-cash deal. When you went into that DST with debt, now you got to deal with debt on it. Okay? So you have to understand, what the risks are of having the debt, that debt is now a part of your 1031 exchange moving forward. So there may be some benefits to the debt. Before the financial crisis, TIC deals could be 60, 70% leveraged. Well, we learned that was a problem. So now we see that the sponsors are capping that leverage at about 55%. And sometimes we see it sub 50%. And a lot of the deals are multifamily. It's a great asset class. And a multifamily property, typically with a good sponsor, you'd have to get down to about 50% occupancy before you couldn't pay all the expenses and the debt service, right? So, the LTV is now at a manageable level. But understanding the debt is really, really important, and you can get some benefits. For instance, so let's go back to the question about a cash deal. Let's say you sell that property, it's all cash, it was fully depreciated. So you don't get a new depreciation schedule. That's a 1031 rule, that's not a DST rule. You can only depreciate the property one time. So if you have fully depreciated it, you don't get a new schedule. So if you go into another all-cash deal, you're not going to get any depreciation and no sheltering on your income. Now, if you took that $1 million back to that example and you put it into the DST that's 50% leveraged, so you took your $1 million and bought $2 million worth of real estate, right? You have an extra $1 million that you bought. You get a new depreciation schedule on that $1 million. So you will get sheltering of your income. So I have to be careful because, like what Pamela said when she was presenting, we don't give tax advice either in my business, right? So you go to your CPA and they will tell you what the depreciation schedule is and how much sheltering you can get. But I have had clients tell me, they've been in the deal 3 or 4 years, they still haven't paid any income tax. But conservatively, 50-60% of your income should be sheltered if you get into a deal that has debt on it and you bought up, meaning, you bought more real estate than you sold. So let me move on. I did not look at a clock when I came on, so just let me know, All right. All right, so let's get through these 7 deadly sins. Don't like the name. These are the IRS rules. Once the offering is closed, there can be no future equity contribution. So they raise enough money for capital expenditures. There's a reserve account. They can't take new money. There's no capital calls. If there's a capital call, something went dreadfully wrong. The trustee cannot negotiate the terms of existing loans. So it's a 10-year term on a note. That property is going to get sold inside of 10 years. You're going to hear me talk about sponsors with extensive track records. You want to deal with sponsors that have turned over dozens and dozens of properties, because when the time comes that property has to be sold, we know that they can execute, right? Because they have a history of doing it. It's really important. The trustee cannot reinvest the proceeds of the sale of the assets. It's not a REIT. They don't turn over properties, buy new properties. When they're sold, you take your money back. You're faced with a new 1031 exchange. Capital expenditures are limited to minor improvements. You'll see some light value add deals. Liquid cash between distributions can only be invested in short-term debt obligations, and all cash must be distributed on a current basis. So they can't hold the cash. A trustee cannot enter into new leases. Important that one lease. How do you do that with a multifamily property when you're new leases every year, new tenants coming in all the time? They have a master lease in place, and hopefully I'll be able to explain enough of it. There are some things I got to get to, before I'm done. The springing LLC, if they did have to put debt on a property, and we don't see it often, because you don't want to see it, it means something's not right. They can spring into an LLC out of the DST, put the debt on it, spring back into the DST so you can maintain, the 1031 exchange. The master tenant is the sponsor who now has that one lease, and they will sublet to the renters in like a multifamily property. The master lease, it should not be a profit center. The IRS requires the master tenant to earn a fee to prevent it from being considered a general partner. Again, reiterate, deal with sponsors, quality sponsors, good track records. If they set this up wrong and don't do it right, it's going to invalidate the exchange. They'll blow it for every investor. So we really got to just get to a couple of slides that I know are going to be really important. So I told you it's a Reg D private placement. The deals I do are 506B, no general solicitations. 506Cs allow for advertising. There's a lot of rules with the securities regulations. There's know your customer. You need to have a pre-existing relationship. It can get very complicated. That's our job as the investment advisor. The 506C deals, they're allowed to advertise. You got to really be careful. It's not the kind of thing, in my opinion, that you do a Google search for when you're looking for a replacement property. Okay, Reg A really pertains to REITs. So here, look, 2006, that bar chart, that was TIC. Okay, and look at the money that was pouring into the TIC investments, and that's why I say it was a colossal failure. There were over 100 sponsors offering TIC investments at that time. It says 71. I know for a fact it was over 100, okay? We get down here during the financial crisis, there were 3 left. 3, okay? Now we get back over here. This is all DST on the upswing on the right-hand side. There's about 60 sponsors today, okay? I'm still working with the 3. I'm working with a little more than the 3, but I placed about $125 million in equity with the 3 that lasted through the financial crisis, because I saw what happens when a sponsor goes away and leaves the investors, who are all passive co-owners, to fend for themselves and what to do with that property. So you work with good quality sponsors and you mitigate a lot of that potential risk. But the business is booming. You're looking at $2.5 billion for 2018. Will easily be over $3 billion in 2019 into the DST. And it amazes me. Show of hands, how many people never heard of a DST before today? Quite a few hands went up. It's shocking to me because I've been doing this for so long. So here's the active sponsors. This is probably the most important slide in the presentation because the selection of the sponsor that's offering the product is the most important decision that you're going to make. A good sponsor is going to make good deals, buy the right properties at the right time, manage them right, okay? Once you get to the point where you got $3 billion in equity coming into these deals, you got new players coming, out of the woodwork, okay? They don't have that level of experience, and you really, really, really have to be more diligent now. That's all it means. You have to be more diligent. So Inland is the big player in the room. These numbers are a little different actually today, because this is 2019 active sponsors, but the Inland is still number 1. Pasco has become surpassed. The underwriting is very tight. They just do a great job managing the assets. They're very conservative with the underwriting, and they have a share in the management expense and the fee, so that there is some alignment there. Okay, but Inland, Pasco, Cantor, up and coming. They've had great product. We were really excited about the product that we've been involved with, the deals that I've done with them recently, and the deals that are coming out. And it's a big name, and there's a lot at stake for them to come out here and do a good job with it. So they're a few years into it, but they've had some good product. Blue Rock's been around. I've been in a couple of their deals. AEI is an old firm up in Minnesota. They've been around for 20 years. They do all cash net lease deals if you need all cash. But net lease, a little out of favor at the moment, but I've done deals with them. And a company not on the list is a local company called Time Equities. They're here in the city. They're a big player, multi-billion-dollar investment company. Love their product. You actually invest with them. They do it as tenant in common, but not like those syndicated deals of years ago. 5 or 6 investors with them. They're like a 20% owner in the deal. All my clients, I show them to Time Equities. So really, Inland, Pasco, Cantor, Blue Rock, AEI, Time. Look, there's only a handful on here. There's like 40 plus in the business. That's where you really got to be diligent, though, is the selection of the sponsor. They're managing that asset for you, and they're going to make a profit or not. Good? Time. So anyway, look, there's a little more to go here. Come see me if you have any questions before the end. I will email everybody this presentation, and had a website roll out today, ericbickniece.com. Take a look at that. Something new for me, and we'll have other presentations that we can come to.
See if there's questions on what you covered.
Questions on what I've covered, thus far. I really raced through it. So the fees are built into the deal. It's an offering. So the sponsor will acquire the asset. There's a load. We call that the load, right? So the fees are about 8 to 10% on the equity. What we look for as an advisor when we're vetting the deals is that fully loaded with those fees, that offering amount, is that cap rate, equal to something that you would get if you went and bought that real estate on your own. So it's built into the deal. You don't pay fees outside. You buy a percentage of the offering, not a percentage of the real estate. So there's no extra, check writing at the closing. Okay?
And what should they expect as return
So the returns are typically, you know, between 5 and 6% cash on cash. That's net of everything. Net of the expenses to operate the deal, net of the fees to put the deal together. So look, here's what I tell people. There's no guarantees. A good deal that works out, you put $1 million into like a multifamily deal 5 or 6 years from now, if you take out like between $1.1 million and $1.3 million, and you collected between 5 or 6% along the way, that would be a good deal. You know, you're not going to hit home runs on these deals. You know, that's not what this is about. It's really about trying to get into a stable asset and deliver the cash flow, but it's not risk-free. Okay, I'm going to turn it back over to Pamela so she can finish up. Thank you.
Okay, before I go on to the second format an exchange can take and comply with the requirements of 1031, which is known as a reverse exchange. Does anyone have questions from the first portion of the program that's burning in your mind that you want to ask now, examples or LLC questions? Yes. If I'm doing a 1031 and I'm selling one property, how many properties can I buy? There's no limitation, only that you fit within the identification rules. So the likelihood is that you're not going to be able to buy more than 200% in value of what you sold. But other than that, you can buy as many properties as you want. Likewise, you can consolidate. So if you're selling multiple properties, you could buy one. So the 1031 rules are very versatile in that respect. Okay. Okay, the question is, if I own my investment property in my individual name, can I convert that to an LLC? Yes and no. The yes is, as long as it's a single member disregarded LLC and you are the sole member, the tax owner remains the same. You cannot add your husband to an LLC, form an LLC and add a husband or a son or anybody else, because then it's no longer a disregarded entity. We're not a community property state. So an LLC that's husband and wife is a different tax owner than husband alone or wife alone. So just be careful.
Can you make a gift?
Your question was?
You can make a gift of an interest and convert the property from a single entity to a double entity. In a
Okay,
sense,
so
and
the-
that shouldn't affect the like-kind exchange.
So the question was, can you make a gift of part of your interest in the property? So if you,
LLC interest.
or of an LLC, which is part of your interest in the property. When you have a single member LLC and you gift off part of the membership interest, that's a gift of the real estate. The answer is you've got to be careful, because if you acquired the property in a single member LLC or individually and you gift part of it away, of the real property or your membership interest, within the 2 years, you could be disqualified because you failed to hold for investment. Okay, so gifting before or after an exchange is risky, because whoever got the gift, if you're doing it before the exchange, likely doesn't qualify. And if you do it after the exchange too soon, after you acquire the replacement property, you could get disqualified for failure to hold for investment.
So you're saying it has to be 2 years before the sale.
Remember, the holding period is not written in stone.
I understand, but the conservative,
Conservative view is don't make any changes to the tax ownership of your relinquished property for 2 years prior or 2 years after the replacement property. Conservative view. Tax ownership, yes. Grantor trust, the tax owner is the grantor in our jurisdiction, okay? So, individual owns relinquished property. Replacement property can be purchased by individual, by a single member disregarded LLC, the sole member of which is the individual, or grantor trust, where the grantor is the individual. They're all the same tax owner. So you can do things like that, yes. You always want to make sure you've got the same tax owner on both sides. It doesn't mean that the title has to be held in exactly the same name. So there's a difference between deed ownership and tax ownership. What you have to look at is, at the end of the day, is the same person or entity filing the tax return. That's where it's critical. Okay? Anybody else? Yes.
What are the rules on refinancing?
Good question. So we touched on that. What are the rules on refinancing? After you close, so let's say you needed to put $2 million. You had $2 million of cash, sale, no mortgage. You bought replacement property for $2 million. After you close on that property, the IRS has never overturned post-closing refinancing. I don't want to see it on the same settlement statement. I really don't even want to know that you applied for a loan during the exchange period. I'd rather you wait till the exchange is done, go get your loan, and then Take out $1 million if you want, leverage it 50%, and go to Tahiti with your $1 million. They have never overturned post-closing refinancing. And I've heard some people refer to it as the nanosecond rule. I don't know any such law, and I'd be a little cautious to the next day going and putting a mortgage on the property. I think you need to wait till your exchange is over, and that usually is at the end of 180 days. Okay? All right, so unless there's any more burning questions, I'm going to go on to some complex topics. Parking arrangements. When you do a 1031 exchange, the garden variety exchange, you sell and you buy within 180 days. There is something called and approved by the Safe Harbor a reverse exchange. So let's first talk about what it is, because there is an awful lot of confusion about what a reverse exchange is and isn't. A reverse exchange is not where you sign a contract to buy before you've closed on your sale. A reverse exchange is not where you sign a contract to purchase and have a contract but have not sold. Neither of those things is a reverse exchange. You can sign a contract for your replacement property, have no contract to sell, and have not closed. Still doesn't make it a reverse exchange. What a reverse exchange is a situation where you actually close on the replacement property before you've closed on the sale. Now, that said, I don't recommend committing to purchase before you've closed on your sale, because if something goes wrong with your sale, you're going to end up having to perform a reverse exchange in order to close on that replacement property and include it in your 1031. And as you're about to hear, reverse exchanges are not for the faint of heart. They are complicated. So I recommend that you close first on your sale before you commit under a contract to purchase replacement property, or you have a lot of wiggle room in that replacement property contract to delay the purchase. Because if not, you could get yourself into an inadvertent reverse exchange situation. Now, many of my clients do reverse exchanges routinely. They tend to be the larger property owners, and in this marketplace where it's very difficult to lock up and close on desirable property, their biggest concern is exactly that. They have a portfolio. Selling right now is not an issue, especially where they're multifamily or industrial owners. So they know they're going to find something in their portfolio to sell within 180 calendar days, which is the time period in which we have to perform a reverse exchange. So in a reverse exchange, we're closing first on the purchase. And we have two options in a reverse exchange. And when someone wants to do reverse exchange, the first thing I'm going to discuss with them is how much they're selling for, how much they're buying for, how much mortgage debt they have on what they're selling, how much mortgage debt they're planning on having what they're buying, and the economics of the situation to make sure that there is enough economic benefit available to them if they do the reverse exchange that the costs don't outweigh that benefit. Because our regular exchanges are $1,000 to $2,000. Reverse exchanges are significantly more. And here is why. In a reverse exchange, we have to park. That means take title to either what's being sold or what's being purchased. One or the other. Which property we park will depend on the client's facts and circumstances. Most of the time, we park the replacement property. The reason for that is most of the time, our clients don't have all of the cash they need before they've sold to buy the replacement property and meet their exchange equation. What am I saying? Let's take an example. Let's say we're selling for $10 million and there's no mortgage debt. How much cash do I have to have invested in my replacement property when I close to 100% defer and meet my exchange equation? $10 million. So now this client that's selling for $10 million, he's under contract, but it's closing in September, and he needs and wants to close on his replacement property July 1. And he's buying for $10 million. And he does not have $10 million for the purchase. He is getting cash from another source to put down $2 million, but then he's getting financing for $8 million. When the client tells me that, I know we must park the replacement property because the IRS does not measure how much cash we have in the deal when it's parked. They measure the amount of equity invested when it gets transferred to the client. So in that situation, here's what would happen. The replacement property would be deeded to an exchange accommodation title holder. The acronym is EAT, E-A-T. The EAT is asset preservation. We form a different LLC for every client, for every parking arrangement. Nobody's property is with other people's properties, okay, for a lot of reasons. So we park the entity in the LLC. Somehow we have to have $10 million to finance it. $8 million comes from a lender. We, the EAT, signs a note and mortgage in favor of the lender. $2 million comes from the client. So we give the client a $2 million note. Now we're closed and parking the replacement property, and let's say it's New York City property. Because it's New York City property, we do not have a double transfer tax issue because there's an exemption at the city and state level. More about that offline. But that's one significant cost you have to be aware of in reverse exchanges if you're in another jurisdiction, i.e. New Jersey, where there is no exemption. Okay? But we're in New York, we park New York property. Now let's say September 1, we sell the relinquished property, $10 million comes into the QI's account. What do you think we do with that $10 million? How much debt can the clients have on the property when they acquire the property? 0. We pay the $8 million loan down to nothing. We take the balance of the $2 million and pay the client back for the $2 million they loaned us. And we transfer the property generally by assignment of the membership interest in the LLC to the client to complete the reverse exchange, and they are sitting very pretty with 100% deferral. Now, things you need to be aware of. You better make sure that lender had no prepayment penalty. They know it was a short-term, quote-unquote, bridge loan, because you can't have financing in that example. Now, if my example was different, if I had $5 million of debt on the property I sold, and I needed an $8 million loan, I wouldn't have to pay off the loan completely before I transferred it. I would have to pay off $3 million of the $8 million loan, then transfer the property to the client. When the client gets it, they've got $5 million of equity and $5 million of debt invested in the property, and everything is pretty. Okay, again, full deferral. We also could park the relinquished property. That happens less often, primarily because most people don't have all the cash, or if they have all the cash, they don't want to put it in. They want to get some bridge financing. But we can also park the relinquished property. The positives of parking the replacement or the exchange equity does not need to be present. That's what we just covered. And it allows for multiple relinquished properties. If we don't know what we're selling as our relinquished property, we don't want to park it, because then what if we want to sell something else? If we're not sure, we've got a portfolio, we might sell 1, 2, 3, or 4 of them, then we park the replacement property. We have 45 calendar days from parking replacement property to identify what we're going to relinquish. And then we can proceed with any of those relinquished properties that sell during the 180 period. And the negative is I've got to start early on these transactions. I need 3 or 4 weeks minimum, and your lender's going to need more before you're ready to close on your replacement property to set this up properly. It's not the time we need, it's the time you're going to need to get all the ducks in the row. Because the lender, if they've already underwritten the loan on your new replacement property, they think that you're the borrower. They're not ready for this EAT to step in and be the borrower. They have to go through a whole new underwriting process. Plus, they have to get their lawyers to get their arms around the transaction. So start early, as everything in the 1031, if you leave one thought in your mind, plan, structure early. When you're buying property, you're not even thinking about selling it yet. You're buying it for investment. Think about how you're setting up the purchase, to structure it, to qualify, and to give you the most versatility. So here's how it looks if you are parking replacement property. Just an example. So we had, again, an $8 million purchase. And we had a loan for 6 and cash went in of 2. And by the way, here's a practical issue on parking arrangements. We park it But from the world looking in, you own it. The exchanger owns it. You have all rights, all obligations, and all benefits and burdens because we net leased it back to you. So you have all control. You don't have to come to us to sign documents or anything else. So that's the way it would look when we park the replacement. Now we're going to sell our relinquished property, and our relinquished property was less money in this example. I think it's $4 million, if I recall. Yes, with $2 million of equity and $2 million of debt. So we are good to go. We don't have to pay anything down with our sale because we had enough equity and we traded up in debt. And so at the end of this period, we would simply transfer the replacement property to the taxpayer exchanger to complete our exchange. On the other side, if we happen to park the relinquished property, the loan and purchase is easier on the new property because the EAT's nowhere to be seen. It's just a regular purchase by your client of replacement property because we take title to what's being purchased. The problem with parking the relinquished property can be that if there's a mortgage on it, the transfer to the EAT could violate the mortgage. It's a due on sale provision. And good luck going to that lender and getting consent to the due on sale to go to circumvent the due on sale, because sometimes we don't even know who the lender is or how to reach them, and by the time they react, it's a little too late for most of our New York minute decisions. So that can be a little tough. Another diagram on how that would proceed, where we're parking the relinquished property. Again, it's deeded to the exchange accommodation title holder. We lease it back to the taxpayer, and then they have 45 days, 45 days to identify what they're buying and actually close on it within the same 180. And more of the diagram. When we complete our relinquished property sale, it's deeded, and here's the distinction. Instead of the relinquished property being deeded from the client, it's now deeded to the buyer from the exchange accommodation title holder because we're parking it. So that's an overview of reverse exchanges. I think it's a little mind-boggling, yes? And trust me, I have attorneys, and this is no slight to the attorneys. They're brilliant. But until you've done several of these reverse exchanges, and not only several, they all are different. Sometimes you're parking the relinquished, sometimes you're parking the replacement. A lot of guidance is needed, and I'm very, very fortunate to have a very strong commercial team who you would work with if you ever have to perform or get in a situation that you need a reverse exchange. So my final format of an exchange, and I'm going to talk about it briefly because I want to get to Section 121 and 1031, how we use them together. It's very, very interesting tool. But my final type of exchange, and I get this question a lot, so I'm conceptually going to describe it without going into a lot of detail. It's a situation where you're buying a replacement property and you want to use some of your 1031 value to make improvements to the replacement property. So I will tell you that improvement exchanges, like reverse exchanges, are complex and a little costly. So they're not for the faint of heart. In addition, with an improvement exchange, the property you're planning on improving again needs to be parked with the intermediary with an exchange accommodation title holder. And the reason is that you only get credit in your 1031 for the amount of money invested in the property on the day you take title to it. So if you close on your replacement property, let's take an example. Let's say you're selling for $5 million and you're buying vacant land for $1 million and you're going to build a building that's going to cost $4 million plus. If you take title to that vacant land for $1 million, it doesn't matter how much you invest thereafter, you only get credit for $1 million. So what we would do is the seller of the replacement property would deed the vacant land to an exchange accommodation title holder. The revenue procedure has very strict requirements. You must, to get credit in your 1031, you must make the investment in the replacement property, and the improvements that constitute real property must be completed within 180 days from the earlier sale of the relinquished property or purchase of the replacement. So example, let's say I sold on June 1 my relinquished property and $5 million came into the exchange account, and on July 1 I close on my vacant land for $1 million. Okay? Now, We parked it with an exchange accommodation title holder. Excellent. We have 180 days from June 1, not July 1, to make improvements to the vacant land that constitute real property under state law and apply our $4 million. However much of the $4 million we can. We don't have to be CO'd. We can maybe just did site work and foundation and it cost us $4 million. But at the end of the 180, we've spent another $4 million. We've got a credit for $5 million in improvements and we have complete deferral. So the people that do improvement exchanges many times are those that have a contractor as an affiliate where they can ensure how much they can get done. Whenever someone wants to perform an improvement exchange, I first send them to their contractor to see how much dollar-wise we can reasonably expect to get done within 180 days. Because if it's not enough, then forget about it. Take your balance of your money, buy more replacement property, and get a construction loan and do your improvements in your own time. Because in improvement exchanges, 180 is tight to spend money no matter what. You need to have your permits in advance or you'll spend your whole 6 months just getting your permits. Here's how it would look. Again, we're parking replacement property. We are giving the tax owner a construction agreement. And by the way, you don't have to come to us. We're not going to go out and inspect the property like a construction lender and see how far along. No, no, no. You send us a request for funds to pay the architect, to pay the brick company, to pay the concrete company, whoever. We pay them in accordance for the request for funds. We do not act as a construction lender. And then hopefully you've got enough done within the 180 days to make this worthwhile. In my example, we had $5 million to spend. We spent $3 million on the lot, $1.2 million in site work, $500,000 in the foundation, and we have perfect deferral. And after our 180 is done, we still have a building to build, but we have an excellent exchange. Planning, planning, planning. It's all about planning. So where I have a client that wants to do some fix-up work on a condo or a residential property, I generally tell them this is not going to be a cost-effective solution. Get a construction loan, use other money, and to the extent you need to spend more money on replacement property, buy something else, go buy a DST and have a really solid investment. Okay, before I get to my last section of the class, which is 1031 and 121, how we can use it together to make money, any questions on parking arrangements? Very complicated. Good question. Improvement exchange. Can I prepay? No, no, no. Why? Because it has to result in real property within the 180. And whenever I've got a client do an improvement exchange, I recommend they get a contractor or architect certificate of completion at the 180 and take pictures. Because who loses if you get audited and you can't substantiate anything? Who loses? The tax owner. We always bear the burden of proof. If you can't substantiate investment intent, you lose. You can't substantiate how much you got done, you lose. So that's just the nature of the IRS, right? Okay. Anybody else on the parking arrangements? All right. Okay, 1031 and 121. So how can we use these together? There's a couple different ways. 5 scenarios, actually. And I'm going to go right into the split treatment, given time. Here's a diagram of what a split treatment transaction would look like. Let's say you've got a brownstone on the west side. You've owned it for years. You live in a quarter, and you rent out 3/4. You're selling it for, I don't know, $8 million. And roughly speaking, each unit is worth $2 million. You've lived in the unit 2 of the last 5 years. At closing, you've got $6 million that will go into an exchange account, or $6 million of value, and $2 million that go directly to the seller. So when you close a 1031, the buyer pays asset preservation directly by wire or bank check. The seller cannot touch it. The seller's attorney cannot touch it. We give you very strict instructions. You need to follow them. But in this case, the $2 million is going directly to the seller because that's not payment for 1031 property. It's payment for primary residence. And the seller will pay tax on that $2 million to the extent it exceeds, their gain exceeds their exemption of $250 or $500. The $6 million goes directly into a 1031. Hopefully they'll get full deferral by spending all of the 1031 funds. So that's one way it can be used. Another way it can be used, is if part of the property, erase that, if 2 of the last 5 years the property was your primary residence, you moved out, you rented it out for 2 years, and now you're selling it. So notice, to get the primary residence exemption, it doesn't have to be primary residence on the day you sell it. It has to be primary residence 2 of the last 5 years. To get your to get your 1031 deferral treatment, it must be 1031 property on the date you close. So, remember early on I gave an example where somebody had purchased property as a primary residence years ago for $1 million. Now they're selling it for $9 million, and they've only got a $500,000 exemption. Ouch. So that couple may decide to move out of that property, rent it for 2 years, then sell it. So at sale, if they sell it for $9 million, $500,000 goes in their pocket, tax-free under 121. And the balance of $8.5 million less expenses would go into a 1031 account because it qualified as 1031 property on the date of sale. Okay, so it's a very nifty tool to use when you know about it enough in advance to be able to plan. And split transactions have a lot of guidance in the code. 2005-14 provides for the exact, gives, 14 or 15 examples of varying facts and circumstances and how the tax code 1031 and 121 can be applied together. So if your CPA is seeking guidance, this revenue procedure is a really terrific source to review. So those are a couple of ways on how we can use 121 and 1031 together. Now caution, if you've bought, no, I didn't want to go there. If you have purchased in a 1031 a residential property and you're renting it, and you are conservative and after 2 years you convert it to your primary residence, and now a couple years later you want to sell it, be careful. First of all, you can't get any of the primary residence exemption unless you've owned the property 5 years. That applies only where you acquired the property in a 1031 exchange. You need to have 5 years of ownership if you thereafter convert it to primary in order to get any of the primary residence exemption. And then, in addition, you're only going to get a pro rata share of the 500 or 250 exclusion. Your ratio, it's reduced by the ratio of the time the property was used as a principal resident compared to the time it was rented. So you're going to get more of the primary residence exemption the longer you occupied it as a primary residence. The shorter, you're going to have that $250,000 or $500,000 reduced. You're never going to get it all again. When you acquire property in a 1031 and convert it to primary, you'll never again get the entire 500 or 250, although you could get a significant amount of it. Okay, so that's examples of how these statutes can be used together. It's fairly complicated. We have a complete brochure on these different scenarios. So if anybody needs more information on that subject specifically, I'm happy to send that to you. Our last slide before we conclude is on FIRPTA. We have a lot of foreign exchangers in the 1031 world in the Northeast. Caution. If you've got a foreign taxpayer selling U.S. property, they need to provide the buyer with a FIRPTA certificate, or 15% of the proceeds can be withheld by the buyer. It used to be you could apply for the withholding certificate and get it within 90 days because that's what the law requires. But the IRS is way behind. So now those withholding certificates are taking a lot longer to get, and you're ending up at closing without that certificate, which means the buyer will withhold 15%. If the buyer withholds 15%, it's going to be boot. No way around it. Well, there is one way around it. You give the seller comes to closing with 15%, separate 15%, gives that to the buyer so that nothing is withheld from the proceeds of sale. if you don't have your withholding certificate. If you don't have the ability to bring a separate 15% to closing and you don't have your withholding certificate, the buyer will withhold 15% and that will be taxable boot. So you'll only be able to defer tax on 85. Okay. I know this was a lot of information. It's 2 o'clock and therefore I am required to let everybody leave that would like to leave. And thank you for coming, and thank Eric and Ron for their sponsorship. And the best way you can say thank you to them if you enjoyed this is by giving them your business or calling them for advice. And I want to remind everybody, you must, if you want credits, I must receive this form that you came in and picked up, and lawyers, you must sign out to get your credits as well. Anybody with questions for Eric or I, we're around afterwards. Please take our business cards. Please feel free to call on us, and thank you very much.